2023 is now in the books. Let's take a look at what worked best last year. Hey everyone, my name is Eric Blattner with Divvy Wealth Management, and as always, thanks for taking a few minutes to watch. Before we get into today's topic, just want to remind folks that if you enjoy listening to our thoughts, really there's two good ways to follow along. First, go over to our website, that's divvywealth.com, D-I-V-V-I wealth.com, and sign up for our blog there. You can also head over to YouTube and subscribe to our channel there if you prefer video. So with that, let's talk about 2023. It's always fun to, at least I'm recording this in early January 2024, so it's always fun to kind of look in the rearview mirror and take stock and see exactly what did well, what struggled. And so this is one of the lighter videos, one of the lighter posts that we'll do, and it's really for entertainment purposes only. I mean, we would never suggest that looking at last year's best performers is a good way to invest going forward. And we'll actually touch on that toward the end to kind of provide a little bit of data that supports that even from last year. So we wanted to look at this through a couple different lenses and a couple different angles. So the first way that we're going to try to identify, quote unquote, some of the best investments from last year is through Morningstar. And they have individual categories where they group similar mutual funds and ETFs. And at last count, they have about 112 Morningstar categories for which I had a return data for 2023. And so they look at all these different categories, and some are really broad, like large blend, and it might include hundreds of different funds. And other of these categories are really, really narrow. They're really tiny. And they might only include 15, 20, 30 funds, something like that. So obviously some big years can kind of skew those differences. But really, there were a handful of very big winners in 2023. And the first is a relatively new category called digital assets. And for those folks that follow cryptocurrencies and Bitcoin, this will be no surprise. Bitcoin was up over 150% in 2023, and that really fueled this category. So the digital asset category was one of the biggest winners. And then we also had three categories where there's a ton of overlap, not in the funds themselves, but in the underlying investments. And so technology, consumer cyclical, and large cap growth. Those three categories were also among the top 5 performing Morningstar categories. And if you look under the hood, you'll notice that there's a lot of stocks that really performed extremely well in these three categories that were owned by funds in each of these three categories. So consumer, cyclical, and technology sectors are two of the most prominent sectors within large cap growth. And so it's no surprise when you see all three of those lumped together. And the final of the top 5 categories is Latin America, a Latin American stock in particular. So, if you didn't own a ton of these types of investments, don't be surprised. Again, Latin American funds, there's very few of them. It's a small category. I think there was about $9 billion in assets there. So it's really not worth a lot of time and attention to really focus there, but it rounded out the top 5. So that's kind of the first way through Morningstar categories. Another way that we can think about quote unquote best investments from last year is geography and countries in particular. And so when I look at this, I just use, for simplicity purposes, iShares has quite a long list of single country ETFs that can serve as a proxy for investors like us in terms of individual exposures. So when you look through this list and the chart that you'll see here, the countries that are represented with the best returns, don't be surprised if you didn't own really any of these. And very few people, actually I don't know anybody that might have owned a single country ETF designed to take advantage of the Polish economy or Mexico or Taiwan or things of that nature. Again, most of these are going to be very narrow. They're going to be highly concentrated in a few companies. And by and large, I think they're going to be trading vehicles for certain people. What you will notice, though, I did want to highlight green, and that's for the United States. We're based in the U.S., and if there's one thing that I think we can agree on is that home country bias is a very real thing that investors experience. And so if you were to look at each of these individual countries and look at citizens or residents of folks that live in each of these individual countries, it would be no surprise that people that live in Poland would have a much higher percentage of their investments invested in Polish companies. And so you look down that list, a lot of Mexican residents will have a higher exposure to Mexican companies. I'm not suggesting it's going to be 90 or 100% or anything like that, but compared to other investors around the globe, home country bias suggests that residents of a country have more money invested in companies based within that country. There's a lot of research that suggests that's the case. So I want to highlight U.S. here in particular because as U.S. investors, by and large, the vast majority of investments that we own will be based in companies or will be in companies that are based here within our borders. And the U.S. had another strong year last year, as you can see here in this chart. So that's one way to think about it, is through the lens of individual countries. Next, we wanted to kind of take a look at quote unquote the market. I think if someone were to ask me, hey, how's the market doing? The first return or the first number that I'm going to quote is probably going to be from the S&P 500. It's generally a pretty well thought of proxy for the U.S. stock market, and it's roughly comprised of 500 of the biggest publicly traded companies in the United States. And so there's going to be a lot of household names in here. And when we sort all 500 of those stocks from best performers to worst performers last year, here's what you see. You may have noticed that AI or artificial intelligence really went mainstream last year and is showing no signs of turning backward. A company like NVIDIA, which supplies chips that really powers a lot of these artificial intelligence programs, was positioned extremely well and led the pack. It was the best performing S&P 500 company last year, pushed its market cap. The company at the end of the year was worth over $1 trillion, which is a big number. So it had a blockbuster year. And the next you had Meta, which is the parent for Facebook and Instagram and WhatsApp. It nearly tripled in value. It was up over 190% for the year. And then we had a few companies that are a little bit more cyclical. And so you've probably heard, or you may have heard, a little bit about the Magnificent Seven. And these are the big 7 stocks in the S&P 500, which really were responsible for about 60% of the index's returns last year. That includes names like Apple and Amazon.com. We already talked about Meta. Google's parent Alphabet is on the list. Tesla, NVIDIA. These companies had just really strong years in general. What you don't hear about are the cruise ships. And the cruise liners really recovered post-pandemic. And so Royal Caribbean and Carnival Corp were two of the best performing 5 stocks in the S&P 500 last year. And the last company that we'll mention is Pulte Homes. Pulte is a home builder, and you may have noticed that interest rates were up for most of last year, and mortgage rates, which are highly correlated to 10-year treasury yields, things of that nature, were also way up. Generally, when interest rates are higher, or basically the phenomenon that we experienced last year, with mortgage rates a lot higher, you saw existing home supply really fall. And I'm a good example. If I've refinanced in 2019, 2020, 2021, when rates were really low, the idea of me selling that home, moving to a different home and refinancing at a much higher rate is not very appealing at this point in time. I really like that low interest rate mortgage. So home builders with less existing home supply coming to the market, home builders were in a spot where they made up a bigger and bigger percentage of the year or of the supply on the marketplace. New homes, new construction, things of that nature. So, Pulte Homes and other home builders had a really strong year from a share price perspective. So that's another lens to kind of look at it. Which stocks did best within, quote unquote, the market, or in this case, the S&P 500. Obviously, we don't own just stocks, so we wanted to look at bonds as well. And 2023 was a year where bond returns, particularly in the fourth quarter, came back in in a pretty meaningful way. Although it didn't look that way through a lot of the year. If you just looked at the price returns for a lot of bonds, many of them were below water through the end of the year, and that's really because interest rates went higher and stayed higher. So fortunately, the vast majority of the return, or not the vast majority, but a big chunk of the return for bonds and bond funds, these indexes comes in the form of interest payments and coupons. And with interest rates being a little bit higher, the coupon payments from a lot of these indexes have also moved higher. So that can provide a little bit more of a cushion, even in the face of rising rates. What you saw last year is the more credit sensitive parts of the bond market really did well. And the parts of the bond market that are very sensitive to interest rates, like U.S. Treasury bonds, struggled the most. And so, when you look at this list here on this chart, you'll see things like high yield. Those are below investment grade bonds. These are less credit worthy companies. And generally, when you go into recession, these are the types of companies where you see default rates tick higher. You generally are rewarded for taking that risk in the form of higher coupon payments, higher interest payments. And when the economy does well, like it did last year, high yield can perform really, really well. And so you had really stock-like returns from a bond category. You also saw similar returns in high yield municipal bonds and corporate bonds. And then if you look at the bottom of that chart, you can see what I mentioned, those interest rate sensitive treasuries, and particularly the longest term treasuries. Those are going to be the most sensitive to changes in interest rates, really struggled last year. And then the last comment we'll make is just kind of a reminder that this is for entertainment purposes only. This is not advice, certainly not looking at single year returns. And so after looking at a few of those charts from 2023, we'll end with one that zooms out a little bit. And I think it's a nice reminder that the trend for the long term, for investors in the U.S. anyway, has been really, really favorable. This chart shows the S&P 500, the growth of $1 since 1928. You'll even see like 1928 was not a particularly good time to enter the market, right before the Great Depression. So the market pretty much went sideways for the next 15 years. But still, over time, $1 has grown to be worth over 270 bucks. The moral of the story is patience generally has been rewarded. And the other thing that we remind folks is that, at least we like to think of it, short-term goals deserve short-term solutions. Long-term goals deserve long-term solutions. So if you have some of those longer-term goals and you've got 10, 20, maybe even 30 years to be patient, then having more invested in things like this, where you can protect purchasing power, where you can see really take advantage of that compounding effect over time, really starts to hopefully sink in over those longer periods. So this is, I think, a nice way to kind of round out the 2023 conversation. Keep in mind, we'll have a new post shortly talking about 2024 and some of the things that we're thinking about heading into the new year. But thanks again for listening. Again, if you have any questions, please feel free to reach out to us directly. And again, we'd ask that you go over to divvywealth.com, check out our website, and subscribe to our blog there if you'd like to stay up to date with some of our thoughts, or click the subscribe button on YouTube to get notified anytime we post something here as well. Thanks again for watching, and Happy New Year.